Banks have been around for a long time, helping people to manage their money. But have you ever wondered how banks revolutionized? Over the years, banks have changed a lot. They started as simple places to keep your money safe. Today, they offer many different services like loans, credit cards, and online banking. In this video, we will explore how banks have evolved from their early days to the modern financial institutions we use today. We'll look at key moments in banking history, the development of new technologies, and how banks have adapted to meet the needs of their customers. Make sure you subscribe to our channel and press the bell icon to get regular updates. Let's get into the video. The origins of banking. In ancient civilizations, people needed a way to store and manage their money. Around 2000 BCE, temples and palaces in Mesopotamia started to become places where people could deposit their valuables like grain, livestock, or precious metals. These early banks also started to lend money to help with farming and business with the expectation that borrowers would pay back the loans with interest. In ancient Greece and Rome, banking got better. Moneylenders called trapezitae in Greece and argentarii in Rome offer a wide range of financial services, including taking deposits, giving loans, and exchanging different currencies. The Romans also created a more structured banking system with public banks called mensae that were run by the government. These early banking practices paved the way for more complicated financial systems in the future. Europe's banks slowed down after the fall of the Roman Empire, but commercial banks grew during the Middle Ages. Italian city-states like Venice, Florence, and Genoa became important trade hubs in the 1100s. Merchant banks were run by wealthy families like the Medici. They helped people exchange money, get loans, and send money all over Europe. The bill of exchange was an important new idea at this time. Using this financial tool, businesses could send money over long distances without moving coins. As trade between countries grew, bills of exchange became necessary. They made moving large amounts of money safer and helped the business grow. The birth of central banks. During the Renaissance, banks made even more progress. In the 15th and 16th centuries, banks started to look more like banks today. The Bank of Amsterdam, which opened in 1609, was one of the most famous examples. This bank had savings accounts that merchants could use to keep their money safe and send money to other merchants through written orders. When the Bank of England was founded in 1694, it was a big deal in the history of banks. This bank was created to handle the government's debt and keep the currency safe. Its work became an example for central banks around the world. It created banknotes that could be traded for gold or silver. This made paying for things easier and safer. As a lender of last choice, the Bank of England also helped keep the financial system stable. Many more banking services and more formal banking companies were set up in the 18th and 19th centuries. During this time, commercial banks started to appear and give people and businesses a wider range of services. The fact that these banks offered cash and savings accounts, loans, and investment services made it easier for everyone to use banks. The first Bank of the United States opened in 1791 in the United States, and the Second Bank of the United States opened in 1816. The young country's economy was helped by these organizations, but there were also times of instability during that time, such as bank runs and financial panics. The National Banking Acts of 1863 and 1864 put government controls on banks. This made the banking system more stable and consistent. The rise of modern banking in the 20th century. The banking business went through a lot of changes in the 20th century, thanks to new technologies and changes in the rules. In 1913, the Federal Reserve System was created to give the United States a central bank that would be in charge of monetary policy and banking industry regulation. During times of economic trouble, like the Great Depression, the Federal Reserve was very important for keeping the banking system stable. In the middle of the 20th century, new banking technologies came out. For example, the Diners Club card, which came out in 1950, was the first credit card. This new idea made it possible for credit cards to become widely used and for internet banking to grow. Automated teller machines, ATMs, changed the way people got their money when they were first introduced in the 1960s and 1970s. In the 1980s and 1990s, online banking came along and changed the way people did banking even more by letting them do deals from their computers. The digital age in banking system. The banking business has changed a lot since the internet and cell phones came out in the late 2000s and early 2001s. Digital banking is now the rule, and customers can use their phones and computers to manage their accounts, move money between accounts, and make payments. The growth of fintech, financial technology, companies has brought new services and competition to the banking industry, pushing traditional banks to come up with new ideas and change with the times. The rise of cryptocurrencies and blockchain technology is one of the most important changes in the past few years. Cryptocurrencies like Bitcoin, which came out in 2009, and others give a decentralized form of digital currency that is different from traditional banking systems. Cryptocurrencies are still new, but they could change the way we think about money and deals. Regulation has been very important to the growth of banks because it keeps them stable, protects customers, and encourages competition. Throughout history, times of financial disaster have often led to more rules and regulations. For example, the Great Depression led to the Glass-Steagall Act of 1933, which kept commercial and investment banks separate in the U.S. After the financial crisis of 2008, governments all over the world put in place tighter rules to stop similar problems from happening again. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 made a lot of changes to the U.S. financial system. For example, it made banks carry more capital and created the Consumer Financial Protection Bureau. Financial inclusion and the future of banks. Banks are very important for financial inclusion because they give people and businesses access to financial services that they might not have had otherwise. Conventional banking services are out of reach for a lot of people in many developing countries. Mobile banking and other digital financial services could help close this gap by making banking easier to get to and cheaper. Microfinance organizations are also very important to financial inclusion because they help people and small businesses with low incomes get small loans and other financial services. People are given more power by these organizations, which lets them start and grow businesses, raise their living standards, and help the economy grow. When we think about the future, the banking business is about to change even more. The future of banking will be shaped by how technology keeps getting better, how customer expectations change, and how regulations change. Machine learning and artificial intelligence, AI, are already being used to help with risk management, find scams, and provide better customer service. Open banking, which lets outside companies create apps and services that work with banks, is encouraging new ideas and competition. Banks are also paying more attention to sustainability because they know how important it is to deal with social and environmental problems. Environmental, social, and governance (ESG) factors are being used by many banks to decide what loans and investments to make. This encourages sustainable practices and helps green projects. Recent trends and the role of AI in banking. In the last few years, there have been several changes in the banking business that are a reflection of how quickly technology is changing and how customers' needs are changing. The use of mobile banking is growing, which is a big trend. Many people now have smartphones, which means that customers can do almost all of their shopping on their phones. Because digital banking is so easy to use, people are going to real branches less and less thanks to this. Another trend is the rise of companies that work with money. These new creative businesses are using technology to offer banking services that banks used to offer. Fintech companies offer services like peer-to-peer loans, digital wallets, and robo-advisors. They tend to be more flexible and customer-focused. In response, traditional banks are working with fintech companies, putting money into their technology and looking into new ways to run their businesses. The banking business is changing because artificial intelligence, AI, is giving them new ways to improve customer service, work more efficiently, and handle risk. One common way that AI is used in banking is through robots. These virtual assistants are driven by AI and can answer a lot of different customer questions, from finding out account balances to processing transactions. Chatbots free up human workers to work on more complex and valuable tasks by automating routine tasks. AI is also being used to find scams and stop them. Machine learning algorithms can look through huge amounts of transaction data to find trends and outliers that could point to fraud. In this way, banks can quickly protect their customers' accounts from possible threats. AI is also being used to make risk management better by looking at credit risk and making more accurate predictions about when loans will not be paid back. As technology advances, the future of banking promises even more innovations. If you found this video interesting, don't forget to like, share, and subscribe to our channel. Hit the bell icon to stay updated with our latest videos. Thanks for watching.